Welcome to Talking Markets with Franklin Templeton. I'm your host, John Shigatsky from the Franklin Templeton Global Marketing Organization. As a forward-thinking asset manager, Franklin Templeton leverages cutting-edge strategies and deep industry insights to unlock opportunities to help grow wealth. We're your trusted partner for what's ahead. We're here today with ClearBridge Investments, Head of Economic and Market Strategy, Jeff Schulze. ClearBridge is a specialist investment manager of Franklin Templeton, and Jeff is the architect of the Anatomy of a Recession program, a program designed to provide you with a thoughtful perspective on the state of the United States economy. Jeff, welcome to the show.
Happy to be here, John.
Jeff, let's start with an update on the U.S. economy and your measuring stick. Jeff, were there any changes to the ClearBridge Recession Risk Dashboard with the October 31st update?
Well, there weren't any changes in October, but it's important to note that the U.S. federal government shutdown has halted most economic data releases over the course of the past month. So when you look at the 12 individual indicators of the ClearBridge Recession Risk Dashboard, 7 of them are from sources not impacted by the shutdown, so they continue to be updated, but 5 of them weren't. Housing permits, jobless claims, retail sales, wage growth, and profit margins can't be updated, but at this point, given the trajectory that we saw coming out of September, we think that there were no indicator changes for those 5 indicators. So if we pull forward the September reading, right now we have 7 green, 4 yellow, and 1 red signal, and we continue to have a firm overall green expansion color for the dashboard.
Okay, firm green expansionary overall single. 5 indicators you said are currently unavailable for the update. I think I can clearly state that that is certainly a first for our monthly conversation. Are you concerned that you're currently flying blind a bit here?
I'm not concerned. Yes, it is certainly a first, but the silver lining here is that there is an abundance of additional alternative data sources that can be utilized to gauge the health of these individual indicators. And when you look at these alternative data sets, they indicate that you've had a continuation of the trend for each of them. So, for example, when you look at labor stress, you can look at alternative indicators from Reviello Labs, the Challenger data set, LinkUp, MacroEdge, ADP, Paychex, Indeed, NFIB. There is a lot of things out there. And we generally look at all of these alternative data sets to confirm what the dashboard is saying. But when you look at these in totality for the labor market, it shows no signs of a rise of the unemployment rate, and the labor market is doing fine. So while there is a little bit of concern that we are kind of quote unquote flying blind, all of the other data suggests that nothing has deteriorated over the course of October.
Very interesting. So let's dive into some of the ways that you're looking at the different indicators. You mentioned the labor market. Jobless claims typically have been a very important indicator for you, and in some instances, that economic canary in the coal mine over the years. Is there a good substitute for this most important indicator on the dashboard?
There is a good substitute, and probably the best substitute that we have, because when you look at jobless claims, they're normally reported by the individual states and then aggregated and adjusted by the Department of Labor. And because the states themselves are not impacted by the federal government shutdown, the underlying jobless claims data still exists. It just needs to be compiled and aggregated. Now, fortunately, there's a lot of Wall Street banks, research boutiques, economic think tanks that have aggregated and compiled this data, and based on their work, clearly shows that the trend in jobless claims has remained steady over the past month. So this means that jobless claims likely remains green, and that's a really important dynamic because, as you mentioned, it's a top-rated variable in the dashboard. It's our economic canary in the coal mine with having no false positives over the course of the last 8 recessions going back to the 1960s.
Housing continues to be in the headlines, Jeff. I mean, do you have something that you're using to gauge building permits?
We have a number of different things that we're looking at. One of the things that's important to understand the future trajectory of housing is the NAHB Home Builder Sentiment Index. It popped by 5 points in the latest release in October. It was on better than expected lower mortgage rates, has home builders more optimistic about sales in 2026. There's less inventory that's expected. So that's a really positive dynamic. Another thing that we look at is the Dodge Construction Network's residential building starts. It rose by 3.6% in the latest release. And while the dashboard focuses on housing permits as opposed to housing starts, the concepts are pretty closely related. So those are some positives, but there are some negatives. When you look at weekly mortgage purchase applications from the Mortgage Bankers Association, it fell in October. And when you kind of put this together, it does paint a near-term picture of a housing market that's mixed, which is actually pretty consistent with the yellow caution signal that we have for housing permits. So this is another indicator where the data is corroborating what we thought was happening with housing permits before the shutdown occurred.
All right, it looks like retail sales is missing as well. Is there an alternative data source for that measure?
There is. There's a pretty straightforward proxy in the Chicago Fed Advanced Retail Trade Summary reading. That's a very long acronym. I like CARTS better. It's a nowcasting tool, basically, that's similar to what you see with the Atlanta Fed's GDP Now tracker. It basically looks at all the data that's been released for retail sales, and it's the best guess of what retail sales would be if it was actually released. And the latest estimate shows that retail sales is pretty firm right now. Also, we're looking at consumer spending trends in the Johnson Redbook's same-store sales metric. We're also looking at credit card spending data from a lot of the large banks, all telling us the same story. Consumer spending is very consistent. So while we may see a temporary hiccup in consumer spending because of the government shutdown and the fact that 40 million people are no longer getting their food stamps, we think as we move forward to December and January and those food stamps are mailed out to all of those constituents, you're going to see a bounce back of spending in the next couple of months. But ultimately, there really aren't any signs of broad-based consumer weakness, and we think the retail sales indicator will remain green once we get that formal data.
Jeff, how about wage growth? Do you have anything to monitor there?
There are, again, a number of different data sets. ADP, Indeed.com, both point to wage gains continuing at the recent pace. Wage gains have moderated. And as a reminder to the listeners, with our wage gain indicator, when wage gains are moving down, that's actually a positive development. That means that the Fed is likely to be more dovish, going to be cutting rates. Inflation isn't going to be a concern. And the moderation in wage growth continues ever since peaking out about 3 years ago. So, yeah, similar to what we've seen with all the other consumer metrics, this is one that will likely continue to be green when we get the next release.
All right, Jeff, let's move away from the consumer section of the ClearBridge Recession Risk Dashboard and talk about the last indicator that doesn't have an October 31st update, profit margins. What are you seeing here?
Well, as I mentioned in the last podcast, corporate profits don't look recessionary with the latest release that we have. We're looking at the National Income and Product Account data, better known as the NIPA data. It's a subcomponent of the quarterly GDP release. And when you look at NIPA data going back to the 1960s, typically as you enter into a recession, profits plateau about 2 quarters prior and then move down in a very dramatic fashion. And NIFRA profits have been on the uptrend over the last 15 months. So this is consistent with what we've seen from the earnings season here in Q3. Earnings delivery has been quite robust. You've seen strong guidance. And even though we don't have the NIPA profit margins data that we use for the indicator, the earnings season is confirmation that profits remain in an uptrend. And let's not forget, if companies are making more money, it's very rare to see a recessionary labor market cycle. So this is a really positive dynamic, and it bodes well for the labor market looking out to 2026.
All right, Jeff, you just mentioned earnings were strong for Q3 S&P 500 companies. Are there any key takeaways that you could share with us from this earnings season, at least to date?
Yeah, so we're not through Q3 earnings season. So, just want to say that the final numbers may be a little bit different, but directionally, these are going to be pretty close. Right now, earnings are beating by 6%, which is the strongest beat that you've seen in 4 years. Sales or revenues are beating by 2.2%, which is double the long-term average. So this is a really good earnings season. When you look at the number of companies that are beating on both earnings and revenues, again, some of this best breath that we've seen in a long time. So this is a really positive development. It's a key reason why the markets have moved up. I think the markets anticipated a lot of this strength, but I think more importantly, with revenue growth firming into next year, that, in my opinion, creates more upside potential for earnings delivery. And I think this is one of the more underappreciated trends that you're seeing in the markets. Lastly, on the earnings season, you saw guidance. Guidance has been very strong if you're thinking about companies that are upgrading their guidance versus downgrading it. So if you put this together, even though we're seeing a little bit of volatility in the markets today, ultimately, I think this earnings season bodes well for the next couple of earnings seasons. And the last statistic I want to share with you is that when you think about fourth quarter earnings estimates, so earnings estimates for next quarter, typically at this point in the earnings season, those estimates have moved down by close to 3%. Today, they're flat. So this is, again, historically a harbinger of positive earnings delivery as you look forward.
Jeff, the hyperscalers, Amazon, Google, Meta, and Microsoft all reported Q3 earnings last week, and the investor reaction seemed mixed. What's your view, and is this enormous AI capital expense sustainable?
Well, you're right. It has been a mixed reaction. Meta and Microsoft saw lower stock prices after their earnings date. Google and Amazon saw pretty solid upside to their stock prices after their earnings release. But I think more importantly, these companies all guided to having more spending on AI capex. I mean, as long as the markets are rewarding them for it, that has strong implications for both the US economy and the trajectory of the market going forward. Because as long as that AI capex is moving higher, and AI capex expectations for the next 12 months were moved higher by 4 percentage points, up to 39% versus last week after we got the hyperscaler earnings, that is going to create better earnings delivery, more resilient economic activity, and ultimately a continuation of this cycle. And I know there's a lot of people that are concerned about how sustainable this spending is. Well, hyperscalers are funding a majority of this spending through operating cash flow. This is a very different dynamic than what you saw during the shale revolution and the telecom cycle in the 1990s, where a lot more of that capex was funded in debt versus today, where AI capex is only funded by 7% with debt levels. So while there's a concern that this is overextended and this needs to come down, based on what we heard from the hyperscalers, they're actually ramping their capex even higher next year. And AI investment right now is only about 1% of GDP, right? It's a relatively small share of the contribution. When you go out to prior large technology cycles, that number is closer to 2 to 5%. So while there is some concern here, I just don't see it over the next 12 to 18 months.
How about any potential trouble that might be lurking in the private credit market after several high-profile bankruptcies were reported last month?
Well, as Jamie Dimon said, the cockroaches are starting to come out, and ultimately, I think there's going to be more cockroaches. I think that a lot of boards are asking bank management teams to look through their loan portfolios for similar issues of fraud. And given all of the lending that's taken place, you're probably going to have a couple of other cockroaches surface. But ultimately, I don't think that this is indicative of something that's going to be systematic. These seem like more isolated instances with the charge-offs related to Tricolor, First Brands, and Cantor Group. While there is some genuine concern here, and this has been an overhang for the regional banks, there's been an overhang to alternative asset manager stock performance over the course of this year. I think as we get the results of those loan portfolio internal reviews, I think that these areas will start to move up in a more sustainable basis. But also, let's not forget, when you look at the big banks and the results that they had, it was a really strong beat across the board. They are highlighting consumer resilience, regulatory tailwinds, and a strong deal pipeline. And I think that that is a reason to be optimistic on banks and the economy more broadly speaking.
Jeff, last week we got our second U.S. Federal Reserve Open Market Committee cut when they cut the Fed funds rate by 25 basis points. In Chairman Powell's commentary at press conference after the meeting concluded, it did seem like he threw a bit of cold water on the argument or the case for a December rate cut. Is the Federal Reserve done at this point?
I don't think so. I think one of the most important things that Powell said is that a December rate cut is far from a foregone conclusion. And I always expected Powell to say that December was not a lock. And while that was a more abrupt tone shift than what I was anticipating, I still think a December cut is a pretty solid base case. Powell has mentioned that there's strongly differing views on the FOMC committee. But when you look at what would be a truly hawkish outcome, it would have been two hawkish dissents rather than just one. So while there isn't a uniform view on the FOMC of what the path is going forward, given the lack of data, I think the Fed will likely cut in December and then wait to assess what's happening on the inflation front, on the economic front, before starting to cut again. But ultimately, next year, with the Fed cutting, the peak fiscal impulse of the one big beautiful bill, and a strong acceleration of the labor market, I think that once we get that December rate cut, I think the Fed is done. But let's not forget, even if it's just 75 basis points worth of rate cuts, that was similar to what we saw in the 1995 soft landing cutting cycle and the 1998 soft landing cutting cycle. So I think that's going to be enough to propel the markets and the economy forward.
Jeff, how about inflation? Isn't inflation still an issue?
It isn't. If you look at the CPI release for September, core CPI came in at 0.23%, which is below consensus expectations. If you look at OER, which is owner's equivalent rent, part of shelter, it was the slowest pace since 2020, and shelter continues to move lower quarter after quarter. So that's a positive dynamic of why inflation is relatively benign. But also, when you look at core goods inflation, which is going to be the area where you're looking for that tariff pass-through, it came in at 0.2%, which really is a lot less than what people are anticipating when the Liberation Day tariff announcements were made back in April. So it was a pretty dovish print when it comes to the CPI. Also, what I thought was positive is you saw a jump in airfares and hotels, which from a demand perspective is a positive because these travel components are firming after seeing weakness earlier this year. So while I think inflation may move a little bit higher as we move through the next couple of quarters, it doesn't seem like it's going to run away. And it really feels more like a one-time price increase rather than it's something that's sustained, which ultimately the Fed would be more concerned with.
All right, Jeff, let's end with two really important questions on the policy front. U.S. President Donald Trump and Chinese President Xi were able to iron out a temporary trade deal last month. What are the implications here?
Well, this is obviously a positive development. The markets were unsure on how this trade deal, quote unquote, would come together. And the outcome was pretty optimistic. Both parties are going to postpone for a year their reciprocal tariffs. There's going to be a 1-year postponement of the export controls on rare earths for China and the 50% rule for the US, and then a 1-year postponement of shipping fees. The Chinese are going to purchase more US agriculture and energy products, and the US reduced the fentanyl tariffs by 10 percentage points, which a lot of people didn't think that would happen for a period of 6 to 9 months to make sure that the fentanyl problem was actually being addressed. But ultimately, this is a really positive development. It's a key reason why markets have moved higher. But the one thing that I want to caution is that although this is going to be a longer détente than what you've seen, likely going to be a year, there's the potential for flare-ups as we move forward because this is not a lasting trade agreement. It's more of a truce than anything else. But ultimately, this was a positive, and it removes one level of uncertainty from financial markets.
All right, Jeff, second policy topic, the U.S. government shutdown. Do you foresee a deal being made soon? And will there be any lasting implications on the U.S. economy?
Well, the current shutdown looks likely to be the longest shutdown on record, surpassing 2018 and 2019, and have the greatest economic impact of any shutdown because today it's much broader than what we saw 7 years ago. But assuming that the shutdown ends in the middle part of November, it's likely going to reduce fourth quarter GDP by about 1%, but you're going to get that likely back in Q1 of 2026 as some federal purchases and investment spills over to the new year. Now, I think that we'll likely get some sort of agreement over the next couple of weeks because things are getting amplified here in November. For example, about 40 million people are losing access to their SNAP benefits, better known as food stamps. And although the government is using contingency funds to pay out around $4.5 billion in SNAP benefits, that is only about half of the $8 billion per month outlay that you normally have. So that's one reason for these sides to come together. Also, air traffic controllers and TSA agents are likely going to start to call out sick because they missed their paycheck on October 28th, and they're likely going to miss their second paycheck on November 10th. And when you go back to that longest previous shutdown in 2018 into 2019, again, a big reason for the end of that shutdown was because of staffing shortages at airports. Also, the military is likely going to potentially miss a paycheck sometime over the next couple of weeks. So the cost is exceeding the benefit right now for both sides, politically speaking. And I think given the news flow that we've heard today, that both sides are starting to think about how we're going to end the shutdown rather than if we're going to end the shutdown. So I see this ending sometime over the next couple of weeks.
All right, Jeff, as we look to close out today's update, do you have a final thought for our listeners?
Yeah, I think a key takeaway here is that although you're not getting a lot of the official data from the government when it comes to the economy, there's a lot of alternative data that we can look at that corroborate the fact that the economy remains on a firm and positive trajectory. Right now, we have a policy mix that you don't see outside of recessions. You have the Fed that's cutting. You have the peak fiscal impulse of the one big beautiful bill hitting next year, and we're likely going to get more visibility on the trade front. We think that creates not only resilient economic activity, but better earnings delivery. And from what we've seen so far with the earnings season, we think earnings delivery probably is going to surprise to the upside next year. So while we're expecting a much more volatile 2026, we think it's going to be similar to the late 1990s where volatility is high and you have some very vicious corrections. But ultimately, we think that those dips are meant to be bought by investors because of this strong policy mix that we have and the fact that earnings have been great and I think they're going to be pretty strong going forward.
Jeff, thank you for spending your time today to provide an update for us on Talking Markets. To all of our listeners, thank you for spending your valuable time with us for today's update. If you would like to hear more Talking Markets with Franklin Templeton, please visit our archive of previous episodes and subscribe on Apple Podcasts, Google Podcasts, Spotify, or just about any other major podcast provider.
This material reflects the analysis and opinions of the speakers as of November 4th, 2025, and may differ from the opinions of portfolio managers, investment teams, or platforms at Franklin Templeton. It is intended to be of general interest only and should not be construed as individual investment advice or a recommendation or solicitation to buy, sell, or hold any security or to adopt any investment strategy. It does not constitute legal or tax advice. The views expressed are those of the speakers, and the comments, opinions, and analyses are rendered as of the date of this podcast and may change without notice. The information provided in this material is not intended as a complete analysis of every material fact regarding any country, region, market, industry, security, or strategy. Statements of fact are from sources considered reliable, but no representation or warranty is made as to their completeness or accuracy. What are the risks? All investments involve risks, including possible loss of principal. The value of investments can go down as well as up, and investors may not get back the full amount invested. Equity securities are subject to price fluctuation and possible loss of principal. Fixed income securities involve interest rate, credit, inflation, and reinvestment risks and possible loss of principal. As interest rates rise, the value of fixed income securities falls. Treasuries, if held to maturity, offer a fixed rate of return and fixed principal value. Their interest payments and principal are guaranteed. There is no assurance that any estimate, forecast, or projection will be realized. Investors cannot invest directly in an index, and unmanaged index returns do not reflect any fees, expenses, or sales charges. Past performance does not guarantee future results. Any company and or case studies referenced herein are used solely for illustrative purposes. Any investment may or may not be currently held by any portfolio advised by Franklin Templeton. The information provided is not a recommendation or individual investment advice for any particular security, strategy, or investment product, and is not an indication of the trading intent of any Franklin Templeton managed portfolio. Data from third-party sources may have been used in the preparation of this material, and Franklin Templeton FT has not independently verified, validated, or audited such data. FT accepts no liability whatsoever for any loss arising from use of this information, and reliance upon the comments, opinions, and analyses in the material is at the sole discretion of the user. Products, services, and information may not be available in all jurisdictions and are offered outside the U.S. by other FT affiliates and or their distributors as local laws and regulation permits. Please consult your own financial professional or Franklin Templeton institutional contact for further information on availability of products and services in your jurisdiction. Issued in the U.S. by Franklin Templeton, 1 Franklin Parkway, San Mateo, California, 94403-1906. 800 dial Ben 342-5236. FranklinTempleton.com. Investments are not FDIC insured, may lose value, and are not bank guaranteed. Issued by Franklin Templeton outside of the U.S. Please visit www.franklinresources.com to be directed to your local Franklin Templeton website. Copyright 2025 Franklin Templeton. All rights reserved. Podcast theme music by Adam Vadovsky.